We'll do it live.
Okay. No.
We'll do it live. F it. Do it live. I'll write it and we'll do it live. F***ing thing sucks.
Yeah.
All right, welcome back, guys. It's been a long time. Well, let's, I guess, kind of, I don't know. It feels interesting being back after kind of like a hiatus. I have some videos filmed that should be coming out over the next week or so and a half. That's how I have to film now. I have to film in like a session. So apologies in advance if you watch those videos and you notice that the price of the equity is not the same price as the day you're watching it. So just note that I filmed these videos that you're about to see in I guess hopefully like not too far in the future. I'm not trying to film a video and release it a month later or nothing like that, but it's with the time constraints kind of adapting to that. But anyways, I've also been doing a lot of content with Sense Invest, so it's been like we're doing shows and stuff. So some of the mental energy goes there as well as the daily labors, as we say. And then, yeah, there's a lot, I guess, to somewhat update about because we're kind of already at the end. Well, February already ended. I don't think I was able to do a February update. We're now in March. So we're at the final month of Q1 2023, which is the culmination of I guess an inside joke almost that we might have to go long treasuries or something like that, but we'll see. And I'm titling the live stream that, CRM blew up. If you remember one of the last portfolio updates, we talked about Meta blowing up. Well, it seems like CRM also has now blown up. So, I'm happy about that, but doesn't really mean much to me right now because I haven't sold yet. I want to also make somewhat of a joke or start off with a joke saying that the sell signal for CRM came in, so it might be time to sell. The buy signal happened earlier, but the same, I'm being almost joking, but almost not. But for those of you who know what that sell or buy signal is, please do not repeat it to anyone because on the low key chance that it is truly accurate, we don't want to ruin it, so let's keep it on the down low. But anyways, as far as like the earnings for Salesforce goes, I guess we can talk about that quite briefly. I noticed that someone made a comment saying that I think it's D's. Where can I find your comment here? I can just pull it up. Here, this comment right here. Meat Spin is bullish on CRM. Sell it now. Exit liquidity has arrived. So referring to that, Kevin might be my exit liquidity. That's kind of funny. That imagine if I sell it to him and then it just falls from there. Salesforce's earnings were kind of interesting because not only did the management team execute on everything they said they were going to do, as far as like the narrative goes, they're going to increase and focus on profitability. If you haven't, go check out my Salesforce video that I made earlier this year. And it was kind of explaining the thesis as to why I wanted to get involvement with Salesforce. Well, all of those points, or at least the grand majority of those points, were addressed by management. Basically, management said they were going to do X, and they did X. They said, we're going to focus on profitability and return a ton of capital to shareholders. They increased the buyback to about $20 billion, and then the actual outlook didn't actually seem all too poor. Remember that while we might see a decrease, in net investment activity for corporations or B2B spending, we will see increased spending and efficiency, and that kind of actually makes sense during a recession. You're might going to cut some of the fat, let's say. You're going to maybe be more lenient on letting go of some employees, but you're really not going to stop spending on improvements of efficiency. A company that I will be talking about, and yes, for some of you might have already heard me talk about this extensively in the community, but I want to talk about it here on YouTube, and this is the first time I'm saying it here publicly, or just using them as an example, not necessarily an endorsement or that I like the stock or anything like that, but Steelcase was a company that I have been listening into here and there just for other purposes. And what I noticed, I'm sitting actually in a Steelcase chair, but what I noticed, therefore bullish, by the way, therefore I have to be bullish. That's a joke for anyone that's new. I noticed that they said, or something very similar, right? They said, we're going to be spending more on efficiency. So who's the service provider that is improving that efficiency? Well, even though let's say other sectors are reducing spend, some sectors, some service lines, specifically in B2B spending for efficiency improvement and in a way driving down costs, they're going to continue to see net investment growth, especially if you're thinking about, let's say, a recession where maybe sales don't grow as much. So in order to kind of peak out some growth, they're going to have to focus internally on some improvements. And so that's good for those businesses. Salesforce is definitely one of them because that's the whole proposition of Salesforce. They allow businesses to operate more efficiently. But anyways, hi, finally alive. Been a while. Yes, it has. Yes, it has. So I like to do these, but yeah, sell everything now. Fabio's final warning. Oh yeah, that should be the title. Thank you, Matthew. Matthew, that was a brutal but funny comment. You said that this is this channel you come for just the intro music, and then you leave as soon as the creator comes on. That was funny. You guys seem to like the haircut for some reason. It's just I cut it short. That's all I did. Just wait until the price equity hit the price in the video and release it then. Yeah. How you doing, JP? Oh, I mean, well, to give you an idea, I mean, I didn't do a live stream in all of February, pretty much. So that should give you an idea. but it's fun. It's fun. Okay, so I will be doing the portfolio update. I will be enabling the update to go live for everyone who, let's say, hasn't seen it yet. But let me actually get that situated. All right, so I have to enable this, and if it's okay, so I have to type something in, and then it updates it. Oh wait, wrong. I need to type it in here, and then it should update for everything. Give me a second, and then we'll go live. Oh, it's not supposed to go there. Sorry, wrong place. Leave. It takes me a minute to do this, guys. So I'll give you a second, and I just type in update, enter, and now let me check on it. It should have updated and populated. All right. Hold on. Give it a second. Up. Oh, I spelt it wrong. I spelled update wrong. All right, that will probably throw a wrench in actually the function executing. So let me actually go back and add the D, and that'll do it. All right, now it should work. Now let me go check and make sure that it worked, and then we can continue from there. There we go. All right, now you guys can see it. All right, and let me also, this needs to update to today. Okay, so there hasn't been really much changes to the portfolio, but I will be kind of talking about some cleaning up that I've done, and I'll also be kind of sharing my thoughts on certain, I guess, changes, but let me go ahead and share my screen so you guys can see it real quick. Yeah, nothing's changed all too much in the line of like Meta. Meta's still killing it. It's been a tremendous performer this year. That's just to say the least. And then Netflix, Alphabet, Salesforce now kind of rising like a phoenix rising from the ashes. Perion's also executing strong. Murphy's is not executing strong right now, but nothing's really changed there. Kilroy is the up and coming one that I've been buying, here and there. Northrop Grumman, so far so good. I mean, not like crazy, but Northrop Grumman, honestly, it's one of the lower convictions core holdings that I have because there are some interesting ones that have been popping up that I've been adding. And Digital Bridge, nothing's done there. Essex is a new one, so this is one I'm going to say. This is one I've been buying, and I'll go ahead and talk a little bit about Essex Property Trust because we'll take a pause here and then I'll continue the update. So let me show you real quick in terms of share price. So if we see what this business even does, it's another REIT. So yes, it's another REIT that I do like. Let me actually take rid of the comment there. And it focuses primarily on apartment properties in California or East Coast. It does have some in other areas and geographies, but primarily its concentration is going to be in the East Coast. And I think it kind of plays into that narrative where a lot of people are seeing, the flight from California, and I think they're trading at, or this company is trading at a discount relative to something like MAA, Camden Property, et cetera. And so irrespective of the net asset value discount that REITs in general, almost in aggregate, have this year, I think that Essex is trading at an extra discount because the narrative's just not looking pretty for them. I think that the narrative is grossly exaggerated, and while there is a lot of merit to it, I think that it's not the death of California per se, and so I'm kind of capitalizing on that and buying up some Essex Property Trust. So I'm getting a decent dividend there. A lot of that in my retirement account. Also have that in the holding company portfolio. You guys know that who are in the community. But yeah, Essex Property Trust, been buying this one. I think the dividend yield's at around 4%. A lot of REITs, and this is kind of getting into the macro discussion that I haven't shared on YouTube yet, so I'm sharing it today. So if you actually listen to a lot of the REITs earnings calls, a lot of them have been saying a common theme here, and that's we're not buying properties. If they are, they're buying very few. But, for example, another holding within the portfolio, KRC, in their last recent earnings report, they said, or the management team said, well, we're not looking to buy anything. We're not looking to sell anything. We're kind of just looking to sit. And that's kind of interesting because, Kilroy was a company that during the great financial crisis was buying. Now, this is the caveat, because you hopefully catch on to that. If you notice what's happening in the private sector market for real estate, there's a major disconnect between what's happening with the cost of capital and what's happening in, let's say, the private sale market, right? What's happened is volumes dried up in terms of activity, and the sellers haven't realized that it's no longer a seller's market. But until then, we have this perceived price action that prices have elevated or stayed the same, and the participants, such as the REITs, are holding off and saying, well, we're not buying. It doesn't make sense. For what we raise capital for and what we can purchase that property for, the numbers don't add up, so we're not doing it. And instead, a lot of them are doing something that REITs normally don't do, which is buy back shares. They're all voting with their dollars, with their actions, and saying, well, outward, we can't really find any deals. We are the best deal right now, our shares. So let's go and buy our own shares because we're trading at such a steep discount. I would agree with them, actually, but I'm biased, right? So whether or not you agree with that narrative or not is up to you, but that's what they're saying. And I think that if you look at Blackstone's REIT, which is not publicly traded, they reported an increase of about 9% in values last year, while I think VNQ, we're going to see for ourselves, because I don't want to misquote the action here. VNQ last year performed below market returns. So let me actually put VU in here, and to kind of illustrate this point, up until, let's go from, even including this recent rally, it's still underperformed, but I actually want to show from, let's say, January 2022. Yeah, January 2022 to December 2022, around there. So about 24% down. I was going to say 25, so 24, 25, it's all the same. And with that, you see that the market, the overall market, the S&P 500 specifically, let me pull that up again to kind of show that. It didn't go down as much. It was a down year for the market last year. We all know that. But for the S&P 500, it wasn't as bad as let's say, the broader REITs market. And if you have been with the channel for some time, I think you guys can recall back in January, February, or March of 2022, I made videos talking about REITs and how I was reducing my involvement with REITs entirely. I sold entirely pretty much every REIT that I had. And this year and the end of last year was when I started building them back up. In hindsight, that was a really good move because VNQ underperformed the S&P 500 by quite a bit. And I thought they were more going to fall victim to what we were talking about, the liquidity crunch, which ended up being the case. I don't even know how many videos I have specifically on that topic with REITs, by the way. I covered with industrial REITs, specialty REITs like I think one of them was Seritage Growth Properties, which was popular, comparing them to realty income. I think I even made videos. Did I make videos on? I think I might have been a live stream where we talked about the tower companies like American Tower and Crown Castle International. But anyways, the point is, I think that 2023 might be an interesting year to accumulate REITs. And I think that, last year their underperformance led to some interesting opportunities where even the discount to NAV, net asset value, is so large now. Even if some of these REIT properties, the values re-rate, you're still going to be trading at a decent discount to NAV. And when you're not going to probably get to NAV. If you do, then you should probably look for the door. Not all REITs will trade at NAV. That's the other thing. So some REITs will always perpetually trade at discounts because everything it's nuance, right? If you're looking at REIT A versus REIT B, there are differences that can change the valuation of each one or what you're willing to pay for it because, let's say, the risk profile is different. And then even then, within the REIT types, there are different operators that, are let's say, handled better by management than the other one, and that should also contribute to the discount that you want to pay, or et cetera. But point being, I think that 2023 is going to be a good year, and I'm actually accumulating some REITs, so we'll see how we'll do this year. I think this year we're still doing pretty good as far as returns go. I might later in this stream, if I remember, I might bring up my returns for this year if you guys want to see that. But as far as like the subsequent years that we've kind of been investing and had this YouTube channel while investing, we've done pretty well. Then as far as the other changes going back to the portfolio that I want to discuss, I did sell some, and you might notice that the position is smaller. Where are you? I'll just go down the list and we'll get to them. Amazon, I've been building it up, buying here and there. FIS, nothing's really happened there. Truist Financial, nothing's happened there. CrowdStrike, nothing's happened there. Markel, there it is, Activision. So Activision, I did reduce the size of the position. It looks like news has come out saying that the deal will go through, or at least will be approved by European authorities. And let me actually make sure you guys can see the tickers and all that. And just I think that it's probably going to go through. The deals that they're making with Sony, Nintendo are pretty good. It's basically equalizing the release and content, so no content exclusivity, no temporary exclusivity for certain video games like Call of Duty, etc. So that was maybe most of the concern by regulators, and that's out of the way. They're going to have to make a different argument now. So I think that it actually will go through, but I am selling here because I just want to actually have some capital for some other things. Just kind of cleaning up. I'm going to keep the rest of the position, and if it goes through, great. If it doesn't go through, fine. If it kind of gives me some pullback here, I might just rebuild the position. It was never a big position to begin with, but I might rebuild it there. There is a video coming out of another merger arbitrage opportunity that I've been discussing with the community for I guess over a month now. And I don't want to just spoil the video, but you guys might have seen it because another member of the community who does make YouTube videos already made a YouTube video about it. You know what? Let's talk about it. So the video is coming out, and it's iRobot. So iRobot's also presenting an interesting merger arbitrage opportunity. And what you're kind of getting there, I think that's pretty big discount now because it's in the 40s and the buyout price is $65. I mentioned it in the Amazon video that came out today, why they want to buy it. It's for the data. And at the end of the day, when you kind of look at the risk that you're taking on, it's a bit different than Activision Blizzard, because if the deal doesn't go through, and these are things I'm kind of saying now in advance, so watch the video just for support because I'm spoiling the video. You're basically taking on the risk of owning iRobot, which is not as an attractive a business as Activision Blizzard. And that was the risk I discussed with all of you earlier. So when we go to the next stock, we have Intel Corporation. And you're like, wait, didn't you just... Yes, I rebought Intel. So what changed with Intel? I think this warrants a pause here in a discussion. So if you kind of don't live under a rock with when it comes to just Intel updates, they actually cut the dividend. They actually did that. And if you see my last update on Intel, it was like that was the last bastion of what I wanted them to do in terms of showing me that they could take on short-term pain and be good capital allocators. They've shown me, or this management team, Pat Gelsinger specifically, and the CFO there, they've shown me good things, right? I've actually really liked this. While the retail investor, I think now is hating them, I actually think it's good. They're showing me that they're willing to take short-term pains for long-term gains. They showed me that they were willing to be adaptable and change their mind about the Mobileye divestiture. Instead of divesting the entire company or 50% of it, I think it was, they instead elected to do a 5% and then gradually over time kind of ease out of that position. That's great. The dividend was the last thing for me that I felt like it was not an opportune moment to be redistributing capital to shareholders in the form of a dividend. I think right now I would prefer them to focus on balance sheet health and even buybacks as a form of capital return. I think that'll be more effective than just a dividend right now. Later down the line, of course, we can reevaluate that. I prefer companies that have selective buybacks and dividends. But like I would say the gold standard of this all is Berkshire Hathaway, very selective with their buybacks, and buybacks can be far more powerful than dividends when done correctly. When done incorrectly, they can be equivalent to just burning money. So that's kind of like the balancing act that we as investors have to kind of evaluate when we're looking at these companies. So most of the time, you'll find that buybacks are poorly executed, most of the time. But you'll find sometimes a business that does it really well. I think that, it's yet to be seen. So I want to be very clear with everyone listening that I really don't know if they will, if it is good or bad, but we will see. The story will be written and we'll look back and see whether or not it was. But that is a huge part of the thesis around Murphy's, right? Murphy's looks very cheap, and the business is looking to buy back a crazy amount of stock over the next couple years. And as long as it remains cheap, right? And if I agree it remains cheap, I would agree with management buying back the stock. That's kind of almost like an individual conclusion you have to make. So that's kind of an exercise you can do mentally and say, if I want to buy the stock right now at these prices, then you probably also agree with them buying the stock in the form of a buyback, right? It's not, that's assuming you're right. You could just be wrong, but that's how I feel with Murphy's. I think like I would be buying the stock at these prices. And so I really do agree with the buyback. So Salesforce, I'm less, because I'll be honest with you guys. If you guys were thinking about Salesforce, I mean, I'm sorry, the boat's kind of passed. Like meet Kevin, he is becoming bullish now. He's becoming bullish at, let's say, I wouldn't say these are attractive prices. Any creator right now is becoming bullish on CRM. They're kind of just jumping on the bandwagon, really. There was a time and a place to be bullish on CRM, and maybe I appreciate at least the notion that they could be my exit liquidity. So I know that some members have sold their CRM because of the signal, but I haven't just yet, but I am on the fence. I'm about to do it. Okay. Highest IQ actually says something in response to this. And it's saying, I wish they would have cut completely. Oh, I'm trying to move your comment. I wish they would have cut completely and stopped diluting by not buying back stock comp. I understand why they would have angered investors a great deal more. Yeah, no, I agree. I think they should have actually stopped completely the buybacks. And I mean, there's a lot of changes that need to be made, and that's going to take some time. I think that, we're on the other end of a cycle. Not the other end, sorry. We're going through the cycle. And the other side of things, if Intel executes really well, which I don't think they're really priced for, I think they're priced to kind of fall on their face now. And I think if they just don't fall on their face and they become, let's say, the number 2 player in fabrication, then we are looking at something that is frankly undervalued. I know it's like to be hated on. And now I'm actually kind of intrigued because I feel like now more retail than before is finally becoming quite bearish on Intel, or at least throwing in the towel on Intel, which makes me excited. But yeah, Viral Nana, is this a replay? Yes, this is absolutely a replay. Salesforce skipped CapEx spending to juice the numbers. Parts of the business are running on a 5-year-old equipment. That guy. Well, that guy. Just so happens that my signal is in line with that. But Salesforce skipped the CapEx spending to juice the numbers. Parts of the business are running on 5-year-old equipment. I'll take a look at that because, I mean, that could be actually the case. I assume you're saying that with more intimate knowledge on the matter, which, you know, would be very convenient for me to give me an excuse, more of an excuse to sell than the current ones that I have. So I see Michael says, I sold CRM after seeing Joseph Carlson's. Yeah, well, but let's keep that on the down low. Let's not talk about that. Capital Mindset. Are you considering adding the German REIT? Yes, I am. I said as much when we talked in, I think it was on Voice. So there's a REIT called Vonovia, and it is the largest landlord in the EU. Some of the things that make it interesting is it trades at a massive discount to book, let alone NAV. So remember, NAV is different from book. Net asset value, or net realizable value. Sorry, apologies. Net realizable value relative to book. So what I use it, what I mean by the word net realizable value, or the phrase, is what they could feasibly get on the market. You could call it fair value, like accounting fair value, like what would be the market fair value of the properties. And I like to use the word realizable value because it's like it's not realized, but it's realizable in theory, right? I think that's not a conservative valuation; it's aggressive. But if you're looking at trying to be a little bit more conservative, maybe book value is better. Not maybe, it is better, because even then you're still accounting. You're basically assuming that you get it the purchase price minus depreciation or accumulated depreciation and capitalization. But when we take a look at Vonovia, they're trading at a massive discount to book. And the thing about European real estate, particularly German real estate, it does actually heavily favor investors in real estate and not owners who live in their own property, which is the funniest thing, because that's like really topsy-turvy for American standpoint. Because in the United States, there is a huge incentive to own your property. There's a lot of tax incentives. There's things you can write off that you actually can't in Germany, which is really funny. But for investment purposes, there are actually a lot of benefits. So, and if you actually look at the statistics, German real estate, they have a renter's economy, basically. And the United States is more of an owner's economy. So more people in the United States, by percentage, own the property that they live in, while in Germany, it's the reverse. The majority of the population rents versus owns. So, and, you know, you kind of take a step back and think about that, and you're like, oh, well, that makes sense because their incentive structure is X, and then what they get is X, right? It makes sense. Talk about Limeta. Okay. Oh, yeah, that's the other thing. Patrick just said something because it's not a REIT, so it's not to be confused with a REIT. It's but it's REIT-esque. It's real estate. That's a more accurate thing to say. It is a business that is involved with real estate because the REIT is a technical term. You know, it's a structure. It's a type of structure. And then when we talk about it, it's typically in the context of an American business that doesn't pay taxes on the corporate level whatsoever, and it's simply a pass-through entity for the individual to pay taxes. So, okay. By the way, that's a simplistic view of it because even when you get dividends from REITs, some of it is capital return, et cetera, blah, 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 blah. If you don't want to worry about any of that, you just hold it in a retirement account, and then it's simple. You're not paying anything. But when you're really thinking about, let's say, in real terms, like if you're trying to be more specific, the dividends a REIT gives you, the part that's ordinary income is not included in, like, let's say what's capital return, et cetera. So there's some nuances there. Okay, we have a question coming in here. Fabio, what do you think about capitalization and R&D amortized over 5 years and the GILTI tax legislation? I have literally not seen any of it. So I've been so busy that I haven't even been able to really think about or see any of these updates. But I know that there's been some discussion about it. I really have to read more into it before I am able to comment on such things. So let's see here. Why is GAAP legal? I know, yeah, that's the funny thing. There's some creators out there who don't agree with GAAP. Seems like a more like a lot more acquisitions are being blocked recently. Well, that's because, Lisa Khan. So Ethan, if you actually read some of the literature that was put out by Lisa Khan back in her day, I think she was in academia, but she's very hawkish towards mergers. So this was something that I might have mentioned when we were talking about AGRD. AGRD was a position we used to hold in the portfolio for not quite some time. Like, it's not a long time, but it's a long time for the channel. And there was a merger between AGRD, Aerojet Rocketdyne, and Lockheed Martin. And I made videos back when that was happening. And that merger was not allowed. That was when, and I'm pretty sure I mentioned in the video, Lisa Khan, that she was very likely to oppose it given her, let's say, track record of how she spoke and how she thinks, etc. So she did. And so she's kind of leading the charge here, trying to block anything and everything of merging. Anything and everything that is merging. Now, some things that they are, let's say, losing things or backing off. They just backed off from the Meta acquisition of some company that's related to the metaverse. I don't really know what it was off the top of my head, but it was something related to that. But yeah. All right. So, and by the way, so you guys have seen the last portfolio update. Keep in mind, I did actually exit most of my semiconductors. The only one that I kept is Cirrus Logic, which nothing's changed there. And then the addition of Intel, which we just spoke about. But other than that, I sold Qualcomm, AMD. I took profits on those guys. I think most of them ran up a little bit too quickly for my liking. And I also want to kind of focus on some other positions there. So if I didn't reiterate this already, I am looking kind of like Salesforce at the door, because I can't really justify the price action or the price movement, and I don't really like the price today. I wouldn't buy it for sure today, but I'm not for certain going to sell it. I'm on the fence. I'm also on the fence about liquidating LYB, Celanese, nah, but LYB, yes. Taking some profits. It's now long-term capital gains, the whole thing, so I might take the profits there. Kind of going down the list, Wells Fargo, I'm not changing anything there. Dropbox recently reported earnings, and it wasn't too good. Whatever. I think Dropbox now, I can say it's been an underperformer for the market, because since I've owned it, I believe the market's actually returned in excess of 18.9%. So it's been a bad position so far. Boston, Omaha, Realty Income. Oh, it's funny because Dropbox is one company that I have in common with a certain particular YouTuber who has a particular skill, not an important skill, but a particular skill nonetheless, for picking companies that go bankrupt. So yeah, that's those of you who know. And then Walt Disney, still that's small, tiny, basically joke position. Nelson Peltz is no longer gonna pursue his activist investment there. So the one that, by the way, Cirrus Logic recently actually really showed some strong performance. I almost wish it was I really do wish it was a much larger position, of course, in hindsight. But the company is actually still like kicking on all cylinders, very well capitalized, etc. The major risk is their exposure to Apple is basically the entire business. So that's again why it's so small. NCR, by the way, NCR is gone from the portfolio. I sold NCR. It is no longer within the portfolio. I took profits on it early February, and haven't looked back since. So I think that the price appreciation of NCR was too rapid, and it's still hinging on and I'll take it. Like, I'll sell it to whoever bought it off of me. But I think that, remember, the thesis was it got to a point where it was really cheap, and the acquisition potential was there, right? And they're going to spin it off or whatever. But point is, now when it got close to the $30 mark, I think that a lot of that discount was gone. It was completely gone. And I was like, okay, I want to, again, liquidate that, hold that cash, and kind of find another opportunity to deploy. I think that this year, it's going to be, you might see a lot of REITs. Like 2023, you might see me buying a lot of REITs. Just be warned in advance, okay? Because I don't really see myself finding any other, mega tech companies or whatever. I think Salesforce might have been the last one for now, because I'm not really finding anything else. That's really been a struggle. For those of you who've been talking to me in private, et cetera, that's really been the theme of this year. was and that's a good thing. That's not a bad thing. You shouldn't really feel the need to rush into a position. If you find yourself doing that, you need to be very careful, because you're almost thinking about investing. You're not taking it seriously enough. If you're thinking that way, in investing is you have to make calculative decisions. It's not supposed to be like a fun little game that you're playing around with all the time. There has to be purpose to what you do. So and especially for, I guess, making content or videos on YouTube about this stuff, it is a passion for me, and I can almost talk to anyone about anything. I can have someone on and we can talk for 3 hours about whatever stock. It doesn't matter. The issue of, like, let's say if this was like a full-time income for someone, you almost are going to be forced to talk about garbage half the time. And I don't want to, do that per se. I'll do like requests and stuff, and I'll give my opinions on stocks, and that's like an endless form of content. But if I have to constantly have a week, every week I'm buying a new stock, dear God, like, I'm going to pick like 70% of the time trash, because that's frankly, it's a market of thousands of tens of thousands of companies. And really there's only a couple handful at any given time that, a handful could be hundreds, by the way, but that are good. Let's see here. What am I getting? Sorry, I was getting a message because we might be doing a barbecue tonight. As far as BASF goes, BASF's also kind of on the exit. I might exit out of BASF and LYB, kind of keep my chemical exposure to Celanese, but it's neither here or there. And then Rode, I also exited Rode. So remember, I go over the ones that I sold, and then they become references in the past investments. So this live stream is me explaining to you guys why I sold today. And the Rode, again, that was just a cleanup. There's nothing wrong with the business. It's nothing terrible. It's just a cleanup. All it is. Then I have two new positions that I want to cover or talk about, and that's Tyson Foods and 3M. Okay, so Tyson Foods and 3M. So 3M, there's a video coming about that. So I will be sharing more of my thoughts in that video. It's already filmed, and I've already addressed it, and it addresses exactly why I wanted to buy 3M, a lot of those ideas. And then Tyson Foods is another one that it kind of, you're seeing the struggle with them kind of maintaining the pricing power relative to like the cost push inflation that they're experiencing on the production side. I think that both present a similar, well, no, not a similar, sorry, distinct opportunities, because 3M reminds me a lot of Cardinal Health. Anyone who's been following the channel since 2021 and then early 2022, you might remember Cardinal Health from these portfolio updates. We held Cardinal Health, and they settled the litigation for the opioid epidemic, and subsequently the market repriced Cardinal Health to where it probably should have been the entire time. And the reason why there was rapid price appreciation in Cardinal Health was there was a sense of stability and the removal of uncertainty from the stock price. So the market doesn't like uncertainty, and as soon as uncertainty is introduced, you should be seeing some sort of discount applied to it. I don't think that the government's going to necessarily bankrupt 3M, but in brief, my opinion is that there's going to be some sort of master limited settlement. And if that happens, it's not because I haven't inside information or anything. That it's just what is normal. It's normal for that to happen. We saw that with the cigarette companies, et cetera. It might be big, like it might be a very big master limited settle agreement, but it will be paid off over maybe decades. And 3M will have to pay that off. That does change the valuation of the business, but is it a $0 business? I don't think so. So that's just my opinion. Could be wrong. And then the rest of these were all updated in the last video. They're just still up here for some silly reason. I will say that Warner Bros. Discovery has recovered nicely. It's up to $15, almost $16. So congratulations to all of you who have been holding on to it for dear life. So let's see here. What are you going to do when crowd plunges 30% after earnings? If it does, I can actually build it up more. So that would be good. So that's the good thing about like cycling through these positions. So I sell off the positions that I have low conviction in, want to clean up the portfolio, frees up cash, have more cash coming in, can redeploy into ideas that present an opportunity. There's usually always an opportunity somewhere. To jokingly quote Jim Cramer, there's always a bull market somewhere. So yeah, that's true in some sense. I apologize if I skip over anyone's. You should have sold out. Oh, I should have sold out of Disney. I was up 20% after earnings, now only 8%. Yeah, but, it happens. And really, I don't really like to sell too much, right? I prefer kind of being almost lazy with the market. I prefer that. Okay, I see some BB, it's me. CRM, good to know it's time to sell because I just shorted CRM on Friday night. Cash market open. Hey, okay, so I'll just say this. The signals tell me that might work out for you, okay? That might work out for you. And I'll also say from a valuation perspective, it's not attractive here. So while I'm not saying it will or guarantee it will, I wouldn't be surprised if it does. What did you warn me about, Polly? Sorry, or are you talking to someone else? I sold my Palo Alto for 23% gain. Do you agree that that's really high now? Likely to come down. I liked it over Crowd and Fortinet simply because they are profitable right now. Okay, so that's something good. So you came to it saying, I'm comfortable with Palo Alto because it's profitable. It gives me some of the growth that Crowd does, not the same amount, but still good best of class company for what they do. And so you had a solid idea behind it. Thing with Palo Alto, CrowdStrike, etc., is it's all relative, right? The valuation is relative to how much they're capable of growing or how much you think they're able to grow, and how much efficiency they're able to produce in the future. How that profitability, basically, how much profitable are they going to be in the future, and then kind of bring that back to today. I'll take, CrowdStrike, not so CrowdStrike, sorry. Palo Alto is up 23%, right? Right off the bat, you're like, wow, 23% in such a short amount of time. I should probably take profits. Not all the time is playing with the soap good. So it could be that, it got to a point where it was extremely cheap, where there was a lot of fear and you happen to have accumulated it. That could be the case. Without kind of, let me actually pull up Palo Alto. It's PNW. No, I'll just type in Palo Alto. PanW. It's not PNW, it's PanW. All right, so let's take a look at that one here. Yeah, pretty much. I mean, that's like all tech right now. All tech is like bottomed. Well, actually, no. A lot of tech bottomed in October. So this was, they had like another dip here. My goodness, they had like another dip at the beginning. Yeah, that's right. CrowdStrike too. I think this one outperformed CrowdStrike though, because I don't remember CrowdStrike being that aggressive. Yeah, let me make sure. I don't remember CrowdStrike. Yeah, CrowdStrike was definitely not that aggressive, but it was January. Yeah, 30%. Well, just 30%. Nothing. Trash. Real quick, I just want to also address Classic Heroes. Intel reducing their dividends could be a good thing. Yes, it is a good thing. Lisa Khan is a commie. Yeah, a lot of people say that, yeah. Intel GPUs are already competing head-to-head with AMD. I saw that. I don't know what merit is that. Is that the whatchamacallit? The integrated graphics cards, or is that the actual graphics cards? Because that's the case. Wow. Okay. If you want a retirement account, if you have it in a retirement account, do you ever pay taxes on the dividends from the REITs, or do you pay tax at the end when you sell? If you have it in a retirement, if you have it in a retirement account for the United States, if you're outside the United States, I don't know. You might have different rules. You do not pay taxes on the dividends whatsoever, even when you sell. You only have if it's a regular IRA, you're going to pay taxes when you take the distributions away from your retirement, any gains, when you take them out of your account, that's when you owe the tax. With a Roth, since it's not tax deferred, it's complete. Well, it is tax deferred, but it's not. You're not deferring taxes into the future. You have no taxes whatsoever. You're paying taxes now, and then that's post-tax income. You're not going to be paying any tax. No tax liability. That's the benefit of the Roth. So, which, by the way, it is not that kind of episode or anything like that. I'm not going to give like tax advice per se, but there is a way to actually own real estate, physical real estate in your Roth IRA. So talk to your own tax professional on how you would go about doing that. But yeah, it is possible. Americans, I'm talking to Americans there. So let's see here. So you also selling CE yet? No, I'm not selling Celanese. Good question. I don't know if I'm kind of behind the chat and I answer the question for you and you're just asking it because it was in the past or something. But anyways, gamble and trash until you reach big, until you stack up into the index and retire. Yeah, well, why not? I mean, that works for you. So I genuinely find it enjoyment in doing this. So for me, it's like not working per se, but yeah, if this is like work to you and you're doing it only for that purpose, yeah, I mean, at some point maybe you just, you know, you index at some point. Indexing is always a valid option, and no one should be discouraged from that. You're saying at the end road. Oh yeah, that's funny. That's good. That's good. So you analyze hundreds of companies, have several you'd buy. Oh, you should analyze hundreds of companies and have several you'd buy only some. Yes, actually. Oh, okay, so yeah, I'm fairly behind chat. Dan Weston says Fabio bought Tyson. We have Los Pollos Hermanos mindset now. It all makes sense. Yeah. Wink, wink, nudge, nudge. Standalone cards, Fabio. What is the standalone cards for? Standalone. Oh, sorry. That's our conversation about. Wow. Okay. Wow. No. Crazy. So that's something that is not really priced in for Intel. But I think Intel's pretty cheap now, especially with management showing me that they have what it's like. Pat is showing me good signs of a manager. I like everything he's shown me. So I'm willing to go back into the position. And this will be the third time, by the way. Each time we've made just paltry profits from Intel, we've gotten lucky. And then this third time, I hope it's like the last time, right? I want to, see what Intel does. And it's smaller. If you haven't noticed, it's a smaller position than what Intel used to be. But I'm fine with it where it is. I might even buy more. Thoughts on the 10-year, 2-year continuing to have deeper inversions, CMBs, default on BX? Okay, so great you bring that up. I can't really comment too much on the CMBS defaults from BX because I haven't really looked too much into it, Ethan. But I can comment on the 10-2-year because that's something I've been talking about on the Sunday call. So for those of you who don't know, on Discord, I do at the minimum a 2-hour Sunday call. They've gone before for 6 hours, but I haven't been able to do a 6-hour call in a long time. So a lot of the times what we go over, we always start the call with macro update. And I've usually been talking decently about inversions and different markets as well, not just the treasuries market, but the oil markets, the contango that we're witnessing there. With the 10-year, 2-year, I think that the severity of the inversion and the length of time of the inversion signals to me that the bond market is, I think we could say that we're fairly confident there is a recession. And I think the market all understands that there is a recession. If you looked at all the bank earnings, I'll kind of give you a quick summary of all of them. We had JP Morgan Chase said soft landing, mild recession. Bank of America said mild medium recession. Citigroup said mild medium recession. Wells Fargo said mild medium recession. But all those other three were leaning on mild, not medium. I think the most conservative one was Wells Fargo. Bank of America's commentary was, we think it's going to be mild, but we're prepared for medium. JP Morgan's was, oh, it's all fine. All right. And then Citigroup's was in line. It was like in between Bank of America's and Wells Fargo's. That's if I had to give you just a quick summary of the earnings reports. And that's, I think, priced into the market. But I think, for example, if it turns out we don't have mild, I think we're kind of maybe priced in for mild, right? But if we have like medium recession or severe recession, then I think the stock market, because I had the poll in the beginning, which actually reminds me, let me actually end the poll here because I think we've been at it for a long time. Actually, I'll give you guys 10 seconds, including the delay of the stream to finish up answering the poll. Have your voice heard and let me know. What do you guys think? So I'll finish my point and I'll end the poll. But I feel like if we have a medium to severe recession, we have lower to go. We're going to see some better prices than where we are today. But if we have mild soft landing, I think that we've already we might have already bottomed, dare I say. And but kind of getting back to your question, I think the bond market is almost saying, no, we haven't. and things are still pretty bad. And there's kind of a couple aspects of how the yield curve inversion will also simultaneously, so it's not in and of itself the cause of the recession, but it can cause changes in behavior that might impact the outcome of said recession to the worst, right? Because it can change lending patterns. because, for the most part, simplifying banking, banks lend on the short term and, they borrow in the short term, lend on the long term, right? Simplified explanation. And if we kind of go from there and you say, well, it costs more money to borrow for the next month or year than it does to lend out for the next 30 years. So, how does that affect lending? Well, it might slow down some lending here and there. You might see some contraction. So, around July of last year, and this is one of the topics I've covered. So I'm giving you guys public on YouTube. This is now late information, but it's something that we've talked about for a while now. It was in July of 2022, we saw the rate of change. So not in absolute terms change, because I showed the members in the call who were participating in the call at that time a graph, a chart that showed the absolute volume of lending was continuing to rise. And that was like, I would provide updates here and there for 2022 all the way till the end. It continued to rise. But the data point that you could extract from that was actually the rate of change, which is actually really important, because the rate of change is nearly as important, if not more important, than just looking only at the absolute value. And I did actually talk about this briefly in a live stream. I think the title of it was in November. I think it was late November or sometime in December. And I provided like an update on my macro thoughts and talked about Cathie Wood's thoughts. If you guys remember the title, gosh, what was it? Anyways, I can't remember the title, but it's sometime, and it's a live stream. So I talk about it in the beginning of the live stream. So you can watch it at your own leisure if you want to, or remind yourself if you've already seen it and you're like, I want to hear what he said again. I recommend it. I think it's good. I said that the holiday season is pretty likely to be still, come out measuring good, right? And that's because the consumer, it seems like they were still kind of operating on the fumes of credit, right? And so credit extensions were still growing. The rate of change had already declined. So that's something to pay attention to. And that was like a red flag that you kind of stick there and say, okay, whoa, rate of change is basic, it's flat. But we're still growing. And so throughout that time, we also saw the savings rate decline pretty drastically. And there are some things to be positive on, by the way, but I know I'm sounding like a Debbie Downer. And then we went through the holiday season, and what did we see? We saw that the consumer was pretty strong. All right. Now come to Walmart. And again, this is no different from last year. Last year in 2022, when Walmart and Target were reporting, I was talking about that a lot, and that had a lot to do with, at least coloring my opinion for 2022. Walmart said something very interesting last year, and this year kind of repeated it to another extent, because they said something along the lines, and I'm paraphrasing now because I don't remember the exact quote, but we are seeing strong performance, but it's because a lot of people are seeing us as like the cheaper grocer, right? And so we're getting a lot of that necessity spend kind of come in via our grocery business because we offer among the cheapest groceries. So that spooked the market when they said that back then. And that was when Home Depot also reported. Home Depot also said that they're probably going to see a reduction in spend in housing. Oh, by the way, I'm closing the poll now because, like I said, it already passed. So end poll. And remember that the real wealth effect is actually not so much from stocks, but from housing, because most people aren't affected all too much about, the price action of stocks. There is a component of the wealth effect through stocks, but I'd say the weighting is far greater in real estate. And the data coming out of both Lowe's and Home Depot is kind of concerning from the consumer standpoint, because we know from studies that if housing prices decline drastically, that actually affects consumer spending. In the United States, not like other economies, but the United States in particular, is 70% of the GDP of the economy, let's say, is consumer spending. So if we look at an indicator, a precursor to consumer spending decline as being housing, we have Home Depot and Lowe's both saying kind of the same thing, how housing's in question now. Well, that brings consumption in question, i.e., that's a form of, what is the word? Starts with a D, two letters, DD, demand destruction. Right? Something that was the theme of 2022. So to kind of color the narrative, we had necessity spend rise. Again, videos in 2022 about this. So videos and live streams. Okay, lots of them. We have increase in prices on necessities. That includes housing. That includes housing in the form of rent, right? Cost of living, housing, food, energy, all those three things. And wages not rising in the same manner as some of these products. That puts pressure on discretionary spend. Consumer starts to, or Walmart and Target start to notice price or consumption changes. The sacrifice of discretionary spend in favor of necessity spend. They said this last year. And then that trickles through the economy, right? We see that start to show up in the projections for some of the industrial companies, right? Because they are the, let's say, upstream for a lot of that discretionary spend. Ripple effects throughout the economy. So now with Walmart's most recent report, and Target, I think, might have already reported or is about to report. I have to check, and I should know that. Just don't have time. But if they already reported, I'm going to take a look, and I would assume some of the similar things. If they haven't reported yet, I'm going to say they're probably going to say some of the similar things. I don't think the trend's going to change. I'm willing to change my mind, by the way, if the facts change. If Target comes out and says like, things are great, not just say things are great. Certain key parts that they talk about show that things are great, then I'll change my mind. But for the time being, it does see that we're trending in that direction, and all circling around to your point about the 10-year, 2-year, is that there's probably something there. There's merit to it. It's not just the bond market that we have to support this narrative. There's other real tangible businesses that are supporting this narrative, Ethan. So long-winded answer to your question, but you can never say that I don't take my time to answer people's questions. I hope I answered your question. I wasn't able to answer the second part because I frankly have not looked too much into it. But I've seen some. I haven't looked at the videos either because I see there has been some clickbait. They could be not clickbait, but that they look like, upon first glance, they're clickbait titles for videos. Let's see here. Okay, so Dan Weston, you mean dividend investor TikTok style? Oh, bro said 401k and IRA are for brokies, but says buying index funds. I'm dead. Who said that? He's projecting. He's weak clown boy. You guys are having a whole other conversation. Without the labor force participation rate going up, we are running into a tight labor market. The Fed will have to bust the labor market with high rates, hard landing coming. I mean, yeah, because that's something we've talked about before. I think I still have the chart saved because every time we bring up this conversation, I like to bring it up. And it's which one? Where's my labor force participation rate? No, that's that one. That's macro data. Is it this one? Yeah, it's one of these. Hold on. Give me a second. It's this one. Open. I don't know why it's not letting me open this file. Snipping tool, Paint. Let's just open up with Paint, whatever. All right, so I'm opening up with Microsoft Paint. For some reason, it doesn't want to just open up with the image, which is weird. So, oh, sorry. Yeah, this is the... No, this is not the wrong one. It looks so similar to the chart. Oh my gosh. Wrong chart. Where's the labor force participation rate chart? Yeah, it's none of these. Yeah, that looks so oddly similar. Yeah, it's so funny. I just realized. Yeah, it looks so... Well, I think I made a point when I had this. Well, where's the labor force? I'm just going to have to Google it because there's too many charts here. M2, no, that's not what I'm looking for. I'm going to give up in 5 seconds and just go Google it. I'm going to just Google it. I know that we're like in the 60-something percentage. Let me just... Yeah, so I think I remembered I brought this up next to labor force participation rate. Let me show you because they do look not weirdly similar. They look very similar. Copy. So that's the labor force participation rate chart. But anyways, so yeah, this is kind of like a interesting chart to even observe, and this is what we're talking about: hot labor market, right? We haven't really ever recovered since about the year 2000, which kind of coincides with this chart. Oh, for some reason that is allowed to open up. So this is one I just saw also. It's kind of like discussing here the trend line growth, right? You can kind of see, well, you guys can see at the bottom. At the bottom, I have it shows you a bunch of the charts that I have here, and I have even more than that. So sometimes it's hard to look through these. I need to work on labeling them a little bit better. But anyways, so kind of coincidentally coincides with labor force participation rate drop off in the year 2000. We actually entered below long-term trend line growth. But it's not like the strongest data point we can talk about. But yeah, just looking at this, we do see that it's pretty tight labor market. Labor force participation rate not really accelerating or recovering to anywhere near where it used to be on a relative basis. Like in terms of percentage points, you can see it's it's not like crazy. Like 67 was around our peak average right there in the year 2000, and we're sitting at around that's 2022. So it's not the most up to date, but it's good enough. 62.2%. So let me actually put this down. Let me bring you guys back here so I can see what you guys are saying. All right. So and then hard landing is coming. Yeah. So if hard landing is coming, then I don't think that's priced in. So, yeah. Alec Beach, what price would you sell Perion at? I'm closer to the sell price than the buy price. That's for sure. So what I'm kind of looking for Peri is some sort of because the thing is, it was when a member of the community found it, right, and brought it forth, it was extremely cheap relative to its growth. Okay, it was extremely cheap relative to its growth, and that was a huge part of the narrative. Like part of the discount was, of course, looking at well, it's an Israeli company, therefore discount there because it's not American. And there were some other kind of scares that, well, the Microsoft contract is coming up for renewal, and if they lose that, they lose everything, right? There's all that. We also saw the rise of ChatGPT, which I'm surprised hasn't actually gained a lot of hype around it, because technically ChatGPT with Bing, et cetera, and Bing becoming more popular is a direct benefit to Perion. That's actually one way to capture that. But I don't really have a price for you, Alex, so I'm sorry about that. Let's see here. Good points, actually. Fabio, I said become so wealthy you don't need a 401k or IRA. That's why I don't have one. But brokies will get offended when they rely on that to retire. I understand the a point there. So you're trying to say that you want to focus on making enough money that you don't have to rely on a retirement tool like the 401k or Roth IRA. Yeah, I get that. Now, I would say that we don't. I get also the point of saying brokey. It's funny, or it's trying to ruffle up the feathers. But I'd say for the most people. Well, also, by the way, government also understands this. So a lot of the benefits, for example, there's a phase out for the deduction on the contributions to an IRA. So you can't just use the deductions whenever, which you're capped out at I think $6,500, and you can deduct it up until a point. But you don't want to say in life that I don't want to make more money so that I have those deductions. That makes no sense. You should always want to try to figure out ways to increase your income. This is not directly saying anything to what you said, Gail, by the way. This is just added stuff I want to just get off my chest. And the Roth IRA also has a phase out for even ability to contribute, to the point where you're going to have to use a backdoor Roth if you want one. I still think you should use one, by the way, Gil. I think everyone, no matter how much money, should, because if you have an opportunity, there are you can put shares of your own business, if it's structured correctly, into your Roth IRA. And if you are a very good business person, then you could generate an obscene amount of wealth and have it tax-free. So You should, but the thing is, you're limited by every single year. And if you're making a lot of money, putting away $6,500 should be of no consequence, right? Why not? $6,500, whatever. It piles up over time, and then there are some magical things you can end up doing with that. But I get, by the way, in the spirit of the comment, it's like, don't try to, or I would phrase it this way: don't try to ever stagnate your earning capability for certain benefits, etc. Always try to make more, always try to improve, etc. And it's kind of like don't allow anything to be kind of like a crutch for yourself to rely on. Try to always find a way to almost like self-sustain yourself. Let's just say it that way, I guess. So always try to look for self-improvement. And then majority of people, if they come to me, there's actually an unnamed person that recently is doing some interesting things, and I think that as we almost getting worried for him because but one of the comments I made recently for this person is, hey, don't try to think that you're going to be like the next Warren Buffett, right? That's not going to be fruitful or productive. You need to focus on income and savings, income and savings, income and savings. And then you need to think about yourself as like a business. Like if you like stocks so much, think of yourself as a business. There are investments you need to make for yourself. There's good investments and bad investments. Like taking certain substances that harm your capability to perform well in the workplace or school. That's a bad investment. Performing well in class, learning the material, or learning a trade if you're going through trade school, etc., and position yourself well. Well, that's like, you're investing yourself in a business. So then you can increase your earning power. Like I'll tell you, master plumbers, right? They make a lot of money. So an investment in your education as a plumber and then eventually trying to get yourself to master plumber, positioning yourself for that to be your future, that's good. You're going to make more money as time progresses. If you're in accounting school and then you're looking to graduate, get your CPA, the moment you get your CPA, that qualifies you for certain work that you otherwise couldn't do. You can start your own business if you have the experience in the tax profession. That can grow your income, etc. And then when you're making a lot of money, then you can worry about what to do with it. Now, just to shout out we have like members that make a lot of money. Because their profession pays a lot, right? They've already kind of done those investments. They're in a great position because now they're in that position where the investing side of things helps them scale their wealth, right? But you gotta build out the firepower first, right? You don't start off with firepower, and it's not a journey that you start with like $1,000 and then you're like, all right, I'm $1,000. I'm going to turn this $1,000 into $1 million. If that's like your strategy, I mean, you're just investing in the stock market, real estate, or whatever, good luck. Because I'm not here to sell you a course that's saying you're going to do that. I also was talking to Cole today. Cole, if you're still in the comments section, it was about real estate, right? Because I maybe want to save this for my live stream with Cole, but real estate does not return the 20-something% that people advertise on average. That's a very rare case. It does not scale that way, okay? If that was the case, you would see a lot more Buffetts of real estate, okay? You have a lot of people who are multimillionaires who generate millions of dollars in wealth over the course of their lifetime in real estate. That's possible, but that's not with generating 20% compounded annual rates of return. No. There's a scale limitation to real estate. And it's because they're miscalculating the return. I guarantee if we sit down and calculate the real rates of return, real estate probably for the good ones, the good real estate investors, is generating maybe somewhere around like the 12 to 15% rates of return. And then if they're really good, 17 maybe in the really high end. But there are projects that can return that kind of amount. Now, I'm not saying that those don't exist, but it doesn't happen like at scale where you can take this to like ultra billionaire status, right? There's certain things that you got to implement at some point, maybe even kind of scale into like open your own REIT or something like that. But anyways, so kind of getting back to some of the comments here. Let's see here. If rates get too high, it'll wreck the U.S. deficit spending. Zastar, I mean, it's not necessarily about that. It's about whether or not whether the system's a bit weird, right? It's like self-fulfilling, self-perpetuating. They're going to continue to lend to the U.S. government, like the banking system's going to continue to lend to the U.S. government. There is perhaps like a theoretical end to the party, but it's. I think when I made a video on it a while ago, I mean, it's just me guesstimating, but I guesstimated with numbers, with math, that about like 40 years, given current circumstances. But that's like 40-year prediction. It's like, oh, okay, that's valuable. Not really. Let's see here. Fifth and final attempt. What kind of data would Amazon possibly want with automatic vacuum? Oh, Andre, I did not see that you asked this 5 times. Apologies. So it's home mapping data. So iRobot's collected, I mean, they've had scandals in the past for the detailed amount of data. I think it was like images of people and rooms and stuff. And believe it or not, that is very valuable because kind of understanding the layout of someone's home can give you some other feedback as to what they might be interested in. More data, the better. And then the thing is, data in your hands might be different than data in someone else's hands. It really depends on what you end up doing with that data and how that data can combine with other pieces of data you might have and together are maybe more valuable than them by themselves. So yeah, my quick response is like basically like maps of your home. So it's easier for them to buy it than for them to build a vacuum cleaner that people buy and then put it in their homes. And they don't have the years of data that the iRobot just has, and it's just like $1 billion something for them. Thanks for the stream, Fabio Spinoza. That guy, I'll catch you guys later. All right, I'll see you at excess returns. IRA has tax breaks, buddy. Oh, you're not talking to me. Have you looked at FLO yet? Is that the flour company? Let me see. I think I have not looked at them. Oh, Flower Foods. Oh yeah, no, I remember you asked this in the private call, Private Sense live stream. So yeah. So I haven't looked at them, but I will look at them. They look interesting. So they basically make bread. For anyone who doesn't know, you probably have their bread products in their pantry. So pretty popular brand. So I'll say that. Hey, no worries, Spinoza. Thank you for coming. Second stream coming soon. I echo the same sentiment. My max IRA and HSA since only $10K a year. The difference for myself is just to minimize my 401K by only getting my employer match. I don't contribute more. Yeah, I would say that I find it very difficult for myself to really want to put more into the 401K besides, well, by the way, so for my employer, you don't even have to even put money in. They put an automatic 6%. Around there, so it's like that's pretty good, but it's very limited. It's very limited. So hey, see ya, that guy. I feel like I'm also not motivated to really contribute to the 401, but I do max out the HSA and the IRA on an annualized basis. The Roth IRA back when I could was maxed out, and yeah, it's why not, right? That's how I look at it. Why not? It's, I'm still putting it to my investments and stuff like that. And remember, you can always take out principal. Principal is not trapped in those accounts. You can always remove the principal from those accounts. And so think of it like, I almost think of it as if emergency happens, right? And, I am sitting on a decent amount of gains there. I can remove from my Roth IRA all the principal that I put in. The regular IRA, no, because you did, hide that money from taxes if you took the tax deduction. So if you took the tax deduction, the government's going to be like, well, hey, that's money you hid away. You're taking it out. You got to pay your taxes now. So you got to be careful with that. Hey, no worries, Gil. All right. Let's see here. Oh, no worries. That's what I'm here for. I'm like the diplomatic. You still streaming? I'm only streaming for an hour, but as in we've only been streaming for an hour. 401ks were invented by a loophole. Jason Do, you should check out IIP. Oh, I've talked about IIPR. There was a stream where we talked about it with Kingdom of Finance, right? So the thing with IIPR, I know it's a REIT. For anyone who doesn't know, it's a REIT that focuses on the Mary Jane space. And they basically act like a bank for these companies that don't have access to banks. Well, they do have access to some banks, by the way. It's a myth. They only have access to like very localized banks. But they do provide a very, very high dividend right now. So if you're into that kind of stuff, I'm just kidding. Everyone's into that kind of stuff. Yeah. Well, the difference is like there's people who are like yield on cost versus current yield, but they dilute a lot. Have you ever purchased preferred shares over common shares? Dan, that's a great question, and yes, I have. Yes, I have. Which I have talked. Dan, I did talk about the preferred shares in a private call, which I know you might have missed it because, again, just so for some context, everyone, if you ever seen one of my private calls, they're like, they can go like for 6 hours. So like sometimes if I say something and someone doesn't watch all 6 hours, which I know the statistics on the analytics say that most people do not watch all 3 or 4 or 5 or 6 hours, or whatever. If it's 2 hours, even not even like this live stream, most people do not watch the whole thing. So if I say something that is of what I think is of value in terms of that, like it's not always caught. So, but I did talk about it, and I will mention that in just a second. But yeah, I feel like IIPR has given, I can observe that IIPR has given up all of its gains from COVID, all of it. And so it's kind of back down to pre-COVID levels. So do you, one, believe in the sector, right? Because if the tenants are healthy, and at least as long as they survive, you'll do great. You'll do great because innovative industrial properties doesn't need its tenants to thrive. It just needs them to survive because they're collecting the rent. So they're in effect, it's a way of less degenerately investing in the MJ space. But yeah, I think I agree to this day. I think it's like it's an interesting / can be attractive opportunity. I feel like whoever was buying it in 2021 was on something. They were using the substances grown on the land when they were doing the research. And I have no idea what they were thinking, or they FOMO'd. Maybe they were doing both at the same time, right? They were FOMOing with the substance. But it should be honestly trading at it should probably trading at a decent FFO yield because there is still a lot of risks and uncertainties here. Because if you look at a lot of the tenants, they're doing pretty bad. I mean, they're doing pretty bad. So there is risk of bankruptcy for a lot of those guys. But will all of them go bankrupt? I don't know. I don't think so. But there are other REITs that I'm really, really interested in buying right now. So. Oh, Kingdom of Finance. By the way, Kingdom, we got to do You Will Lose Everything, especially after that other YouTuber took the title from us, man. What is this? What is this? Yeah, we gotta reboot it. I know we've both been busy, but we got to reboot it. Do you look at any Australian stocks? Yes, of course. There was a BHP. BHP was a stock I had involvement in, but I no longer have involvement in. But I had involvement in BHP. There is an boutique accounting business. I forgot the name of it. I had involvement with it in the past. It's actually a really good business. Chris Hanathan, something like that. Something like that. But it's a really nice business. Australia has some very interesting tax laws surrounding the dividend, by the way. For anyone who doesn't know, I highly recommend you look into it. All dividend investors will become instantly jealous of Australia's tax laws. In fact, actually, you should be jealous of New Zealand's tax laws. Like, what the heck? It's like they have a Labour Party government, but their taxes are like so much better than the United States. What is this? Div taxes do suck, though. Yeah, they do. Well, you got to make a decent amount of money before they even come into effect. So I already answered that one. Do you ever purchase preferred shares over common shares? If so, what scenarios do you see preferred shares being more advantageous? So I look at preferred stock as just a way to secure income. I mean, that's all I see it as. And you want to be careful with preferred stock. How do I put this nicely? So it's a wholly different level of analysis between preferred and common stock. Common stock, you're trying to make sure that the equity of the business itself, will perform excellent, will perform amazing. With preferred stock, you're looking at survivorship. You're looking at coverage. So you're not looking for like, will this business do great? Now, if it does great, there's opportunity to, let's say, maybe re-rate if it's doing really poorly now and it does. But Ben Graham was really accurate when he said this, that why he disliked preferred stock. But I think there's nuance to that, because preferred stock can be very lucrative. But the thing is, I believe, and I'm a firm believer in this, most people should not touch preferred stock. They shouldn't touch preferred stock, because let's say, hypothetically, right? You buy, let me actually pull up a preferred stock as an example. So I'm going to pull up Bank of America's. And I think it's this one. Yeah, it's this one. So pulling up Bank of America's preferred stock right here. So you have the 5.875, currently trading at a yield of 5.95. It's a very small discount, very small discount. So for those of you who don't know, $25 is a very special number for preferred stock. Very special number. And you can see here, it trades at a relative premium sometimes, and that all depends on how, first off, the premium to, let's say, the risk-free interest rate, et cetera, the spread on yields, basically. So that will have an effect, as well as the market's interpretation about the business being a going concern. Right now, there's no concern about Bank of America. So you shouldn't be seeing that much of a discount to redemption. And with that being said, a preferred stock is almost like, think of it like a interest-only loan. It's actually very attractive for the business, and it's also attractive for the investor under the right circumstances. So let's say, Dan, you're like, I want to borrow money to buy a house, to buy real estate, and I'm the investor. You come to me and you say, hey, Mr. Fabio, I'm looking to buy this property. And I say like, oh, I check you out, and you're like, oh, yeah, you're good to go. You're good to go. Like, you got the money, et cetera. So I'm going to lend to you. And let's say, to keep the number simple, it's $1 million commercial property. I'm going to give you the money, $1 million, right? Let's not, no money down. Let's just borrow $1 million. Let's keep the math simple. And then I say, okay, we're going to issue like some preferred stock agreement, keep the math simple, 5%. So you have to pay me $50,000 a year for you to, have this loan. And the thing about a preferred stock, some of the benefits, we're not going to, well, I'll mention like the difference of cumulative and non-cumulative preferred shares, but now Dan, all he has to do is pay me $50,000 a year. He never has to pay back the principal, right? If we're keeping it simple, he never has to pay back the principal. A bond, there's a maturity date, right? There's a day where he has to pay me back the $1 million by the end of that day, because it's a debt. He has to pay me back. Well, preferred stock is like a debt, but it's a debt with like more liberties, right? So it's very attractive to Dan, because he's going to say, hey, I only have to pay $50,000. I never have to pay it ever again. Like, I never have to pay off the loan, and the property price can appreciate, the rents can go up, and he basically bought that property for a perpetuity of $50K a year. So let's say, year one, let's say he grabbed a great deal. He's generating like $60K a year. And so he's profiting about $10K from that. And then, the next year it grows and grows and grows. The rent keeps growing, the economy keeps growing, et cetera. That area keeps growing, et cetera. And even if it's marginal, it's great, because he leveraged up a lot and he's basically paying only interest. So that's the benefit of like preferred stock. It's flexibility with the capital. And but the drawback is, right, if there's like a discount to the redemption value, and the business does fantastic, phenomenal, right? Dan does great, right? He's just like buying properties left and right, and his business is growing and growing and growing and growing. I'm not going to participate in any of that upside. Now let's go to like bonds, right? Well, but the benefit of a bond is the security. Well, it's even more secure than a preferred. So Benjamin Graham didn't like preferreds because he said they didn't participate in the upside and they don't have the security of bonds. The bonds do. So then what's the point, right? I agree with that. Like, if you bought Bank of America preferred stock, I don't know what's wrong with you, right? There's something wrong with you, because it's not attractive. No way around it. I think you'd be silly to buy it, especially right now. It's trading at a very marginal discount. So now let's change it up a bit, right? It's not going to happen. And this is why it's like you're going to waste so much time trying to find preferred shares that do maybe offer some benefits that, think about the time you're putting in. But and then, the upside, it can be dangerous. Sometimes you're dealing with dangerous companies, like companies that actually might be of going concern. So keep that in mind. Like that might be a question. So Bank of America, let's say it trades at $15. Like the preferred shares are trading at $15. The yield is now at, I don't know, it'd probably be 10%, something like that. So now maybe it's attractive because you're locking in a 10%, and you think that the market just absolutely went crazy for a moment, and you don't think Bank of America is going to go bankrupt, and you're securing an income. And then once the market kind of calms down, you get that upside up to like around the 25. Maybe it gets into the premium range again. Maybe it goes to like 27. But you're not going to get it from like the common stock, where if the common stock were to decline around there, it could theoretically go up infinitely, right? You'd benefit from the improvement of the business. The preferreds, you don't. The preferreds, you only get your dividend. And then if it trades at discount, the market won't go too crazy above redemption value. If rates come down a lot, like we get to like negative rates or something like that, yeah, you could see some excess upside from that too. But you're really limited. So just keep that in mind. So there are instances of some companies where I will decide to buy the preferred. I have one big position right now in some preferreds, and I typically like, by the way, if you're wondering, I don't know if people need a reminder of this. So for the portfolio updates, since the very beginning, I only show common stock. I don't show alternative investments. I do not, and that includes preferred stock. I don't show options. I have specific videos where I discuss about options, but no, and I don't show alternative investments, such as when we had TTT in the portfolio last year. Wasn't like a huge piece of the portfolio, but it was there. Will mention it if people ask about it, but I do not show it in the portfolio per se. It's just common stock, simple. So there's that. Okay, but hopefully that answers your question, Dan. And I almost forgot to mention the caveat. So there's preferred, accumulative preferred stock, which simply means, it's very simple to the name. So if they don't pay you the dividend that year, they owe you that dividend. So before the commons get a penny, they got to make you whole. They have to pay everything that they owe you, which those should be trading at a premium than non-cumulative preferreds, because a non-cumulative preferred doesn't have that protection of the dividend being paid out. So the only ones that I own in my portfolio are cumulative preferred stock. And again, the way I view them, honestly, is I purchased income. That's how I think about it. Okay. And they've done well. I can tell you the preferred stock that I've purchased, the preferreds that I've purchased, one of them is up like 15-ish%, and the other one is up like around 11, 12%. They're both like similar industry. And both cumulative. So I can kind of rest a little bit, but not really rest easier. They were a bit distressed businesses, but there's a lot of nuances. It's a completely different world from analyzing debt versus equity. So yeah, there's that. Okay, so let's see. I would love to get some Home Depot. Can you talk about life and philosophy with a sidekick? Yeah, of course. Domino's gives me the... Okay. Just like Carvana, you're fine. EQC is trash. Thoughts on buying Google at low 90s or lower? I owned it for... Oh, sorry. That's so... James, I'm a fan of Alphabet, but I think there's other things I'd rather be buying right now. But that's under the context, like you see how much Alphabet is in my portfolio. So if I didn't have any Alphabet, I feel like it's an okay buy today. 90 and lower, it's an okay buy, right? You could do way worse. I think that you're going to benefit from like the narrative shift against Google. So I think it could do well. Gonna invest in Viva soon. Hey, maybe it's time to switch out of CRM into Viva. I don't know. Thoughts on Coke? Coke. Well, there's Coke, the bottler, which is the ticker that you're putting in there, and then there's KO, which is Coca-Cola. But Coke, the bottler, awesome business that no one really looks at, and does economically benefit from Coca-Cola as a whole. So they've actually done really well, by the way. If you guys haven't seen this business before, let me show you guys. Like really well. So look at that. It's expensive. $500 per share. Expensive. Joke. So on the 5 year, they're up 192%. like absolutely destroying the market there. And that's excluding dividends, by the way. So include dividends in there. Yeah, there you go. And then, yeah, the max chart, 2,800%. I got to say that right now, it's probably kind of like, if I had to almost guess, it's more like in line to fair value. There's not really a narrative discount. There's no discount whatsoever. I think people are aware and acknowledging its quality, even though it like has a P of 13.7. It's really about the relative growth in the future, and I think like it's very mature now, and there's certain efficiency improvements they can make to grow earnings, et cetera. They can kind of see it how Coca-Cola expands its deals, its network, et cetera, and that could be good. That will be good for Coke. But yeah, no, it's a good business. It's a good business. It's definitely one that if you didn't know exist, you need to know that it exists. Bro, TTCF only $1. Wait, I haven't even seen this business in like over a month. Wow. I am so, this is so funny because guys, I know some of you kind of followed Capital Mindset last year, but like 2021, man, making videos on Tattooed Chef and saying it was garbage and getting flack for it hits different looking at it at $1, right? It feels different. Down 90%. Wow. Yeah, that is. Oh, and Home Depot, man. Home Depot, great business. Lowe's, also great business. They're both good businesses. And the most recent earnings, it took it down a peg. It's still high for relative to like pre-COVID, but I mean, there's something to be said buying a fantastic business for a fair price. I think that kind of exemplifies Home Depot and Lowe's. I think over the longer term, this is definitely like, it's a solid business to own. Let's see. I didn't want to see. Ordinary people should just buy PFF. Let me see what PFF is again. What is this? Preferred and income securities. Yeah, but I wouldn't buy an index. No, I would not buy an index. This defeats the purpose. So I would say I'd go further than you, Jason. I'd say ordinary people shouldn't buy preferreds. Just period. Okay, just period. Like you're gonna do fantastic. Like I'm not buying the preferreds for like crazy outperformance. I'll say that. Like it's for like a different style. Okay, so if you're focused on you're trying to build up your wealth. You don't need preferreds. You really don't. You really don't need preferreds. They can be fun. They can be exciting here and there, but like there's an added layer of difficulty. I would never say that someone should be involved with this product. This product is no. I would not get indexes. I wouldn't even be a long-term holder of bond indexes. By the way, these are instruments that are meant to be traded, not invested in. These ETFs are very different from VU. VU, you own forever. SCHD, you own forever. VTI, you own forever. All those guys, you own forever. VT, you own forever. This is meant to kind of fit a narrative, right? It's very similar to like TLT. It's meant to fit a narrative. You're not meant to hold that forever. If you're doing that, you're doing things wrong. Someone told you something wrong. So if you have a friend that just started investing and they opened their M1 Finance and they're like, oh, I'm going to do a 60-40 portfolio. I'm going to go, that into stocks and then some into like, I don't know, TLT or whatever, to bonds. No, doing it wrong. You want like actual bonds. That's what you're supposed to do. Put like actual bonds. Like you can buy like actual treasuries. If you're worried about like risk, it's like, okay, dude, chill out with the risk because that's like the one thing you can legally give financial advice for, not be licensed, by the way. It's like treasuries and I think savings accounts, FDIC insured products. So yeah, you can almost think of like CDs also as part of that portfolio of bonds, right? I don't know. Which, by the way, you can buy a brokered CD. I recommend that everyone look into it. So if that's the first time you ever hear that, welcome to the community. And I'll kind of give you a quick introduction on brokered CDs. So you go to a bank and you say, I want to open a CD, and they say you lock up your money for this amount of time. Or you could go to your broker. You go to your stock account. Instead, you go to the fixed income section. You click fixed income, you look for brokered CDs or CDs, and then you can buy CDs on an open market. These are more liquid and they have a maturity date. You can select which one you want, you invest, and then you'll get your interest plus your money back at maturity. They're fairly safe. It's a CD. They're as safe as other CDs, essentially. And, they're more liquid. You could sell them, right? If the only risk you really have is if interest rates kind of fluctuate and to the let's say your detriment, and you need to sell within that time frame, and you're going to get maybe less money out because interest rates changed. For example, interest rates rose a lot. But if you hold to maturity, you won't have a nominal loss at all. So, unless the world ends, of course, something like that. Same with like treasuries. Same point. Let's see here. A year later, you're hitting those TTCF commenters with spicy replies like, "Oh yeah." So that's something you get to know about me too. So you guys love You guys saw like sometimes my comments I made, even like on other platforms. I left comments before on stuff about Alibaba, and I would get a lot of flack for it, right? I made a comment saying, I disagree with like basically the thesis of Alibaba. I have so much content on Alibaba, you guys can check that out. But I would go back and say like, little snarky comments here and there. So thoughts on CVS? Great business, doing a lot of better moves than something like Walgreens. CVS is perhaps it's trading at a deserved premium to Walgreens. They have the insurance business that really helped them in 2022. They should do well in a high interest rate environment because they have an insurance company inside of them now. And I think they're integrating they're vertically integrating health and wellness really well. So at this point, they should just buy a gym. Not gonna lie, should just buy Altria. MO. Oh, for like a fixed income. Yeah. There's a case to be made. Altria, BTI, etc. Yeah, those guys, because pretty stable businesses. Recession, they don't really care about recessions, etc. But yeah. There's still a chance with TTCF. Thoughts on Ligma? Yeah. You are subject to 10x market returns. I know. But guys, like Carvana. Carvana is the biggest buy of the century. Capital mindset. If MPW is committing fraud, will the auditor discover it? No. The purpose of an audit is not to actually detect fraud. If they find fraud, that they have to say something about it. But it's their job is not to find the fraud. They're not certified fraud examiners, CFEs. So CFE is a separate designation from like a CPA, where you are actively hunting for frauds. Like if you find it, you are supposed to say something, but you're not actively trying to find it. You're vouching for the most important things, but fraud is often not found in the most important parts. Okay. So like, the Enrons of the world, like, yeah, those guys were doing really big things. That's why it was a big scandal, because it should have been something that should have been tested for, but fraud often happens in like the smallest parts. Right. But I'll use utility stocks as bonds when I'm 50. Yeah, but the thing is like, yeah. I mean, there's something you said about that. Well, I mean, you could just be using dividend stocks at that point. Why not? I mean, your goal should be just have so much money that the dividend stocks you'd be making enough just on that. But yeah. Oh gosh. Yeah. Exactly. True. You could just have a lot of money, and your Coca-Cola is your bond, Coca-Cola stock. Because that's the thing about dividend growth investors, is like they focus on yield on cost, and then over a long period of time, that yield on cost can get pretty crazy. There's no reason to sell. They never have to realize the capital gains. Like PPC Ian. Yeah, PPC Ian is a very wholesome character in my opinion. It's fascinating to watch him through his journey. If he ever sees these videos, or these live streams, this commentary on him, I think like you can see a lot of characteristics of a retail investor inside of him. I feel like he does change his mind a lot. You could put it out that like, but he's open and transparent about it. So he just changes strategy a lot. So sometimes he's like, okay, I'm focused on my core holdings. I'm going to my high yielders. I'm doing this, I'm doing that. But you're seeing his evolution. And from my understanding, he's actually performed pretty well, just beating the market, I think. Just beating the market with the strategy. And, at the end of the day, that's why I don't hate on, dividend investing, dividend growth investing at all. I'm almost to the point where I'm a huge not champion, because that sounds like I represent it, but believer that it's good. It's a net good for retail investors because it makes them focus on the important things like earnings, business quality, etc. Not yield chasers. I always have to say that because with the huge distinction between dividend growth investors and yield chasers. So even though, some high yielding companies aren't like bad, that's not, always, but a lot of times you'll find that to be the case. Let me actually respond because I got a phone call here. I just got to let these barbecuers know that I am in the middle of a live. Okay. All right, there we go. So anyways, coming back to the topic at hand, how did you discover the strategy of slowly getting into a position, not buying all at once, or did you perhaps learn it from someone else? So I did learn it. And it's also like kind of also, going through investing yourself. So I've been investing since about 2013. And that was, I guess, there were some growing pains, right? There are always growing pains. No one begins any journey like knowing a lot, right? It takes a lot of time. And then kind of progressing that journey, you experiment, you do try things, right? One of the oldest stocks within my portfolio, when the portfolio was a lot smaller, is Alphabet. And, Alphabet hasn't even been the best performer. It's just the one that I've consistently owned since the beginning. I have never sold a single share of Alphabet, ever. You could argue that, remember, Amazon, I sold it and I brought it down to a small position, but I never divorced it. So in some ways, I can think of it that at least some of the Amazon shares have been with me since the beginning. But I can never say that I never sold shares of Amazon. But I can say that about Alphabet. So slowly buying it over time is still something I don't always adhere to, right? I didn't with Salesforce. I didn't with GPN. I didn't with Northrop Grumman. I didn't. I bought aggressively, but I feel like there's like a time and place. I feel like for any company, I like kind of create personalized ranges for when I like it. And I kind of just follow that. It helps me strategize. It helps me keep my calm, keep my cool, and really understand, okay, what am I doing here? I need to think of it calm and collectively, not just going in like crazy, right? So I'm disciplined. I like to think I'm disciplined with investing for the most part. I have some times where I'm just like throwing in there. Let's see here. Wish RTX would go back down. Absolutely. I think the same thing. Another good one. When is this guy going to take his shirt off? If you super chat me $1,000, I'll take my shirt off. That's right. I'm a high end. No, I'm not going to say that. I'm a high end worker at Rick's. How did you just? Oh, okay, I already answered that. Fabio, go eat barbecue. And live stream it. LOL. No, yeah, that'd be funny. Fabio, EMB might be a good time in. EMB. What is EMB again? There's so many tickers out there. Oh. Okay. Emerging market bonds ETF. Yeah, maybe. I don't know. I prefer to just stick to the TLTs of the world if I'm going to play yields. Carvana is actually my biggest regret. I had 100 shares at $3.80, a couple of covered calls, and ran through 10. Shake my head. Yeah, I know. Carvana's been crazy. Why is this chat simping on Carvana? CarMax looks interesting. Carvana is the best. Thank you for answering. Tell them you're joking. Joking about what? Oh, yeah. Yeah. I'm totally not joking, guys. Clownface, head I held. I gotta get my mom CC BRB. All right. With all that being said, guys, Fabio, I dare you to put Carvana in your portfolio. If I do that, I'd buy one share. I'd buy one share for the jokes, but Yeah. All right. If you guys enjoyed this live stream, let me know by leaving a like. And, you know, if you so wish to share this with other people. I know these are long live streams, but I'm going to start closing it off here. And yeah, those are the portfolio updates. Those are the changes to the portfolio. Again, 2023 to summarize, I think it's going to be a great year for me to acquire REITs, but I did not address NVDS. Let me pull this up. Hold on. Talking about this one? 1.25x NVIDIA. Oh, yeah, maybe if you want to take a short-term bet swing against NVIDIA. Oh, yeah, that'd be nice. Yeah, that'd be nice. Buy 1 share of Carvana. Thank you for the super chat, Jason. Buy 1 share of Carvana. You are dedicated for me to buy Carvana. Okay, I will buy 1 share of Carvana. Basically just grabbing money and throwing it away practically. But if it triples and quadruples, Z Jason, you will be able to tell me that you told me so. ARE, what is that? No, I have not looked at ARE. Oh, Alexander Real Estate Equities. I think I looked at this a while ago. This is another office. I'm pretty sure. Yeah, this is the other office building. Kind of following the similar trend. They're all cheap. A lot of them are cheap, but some cheaper than others. So, but yeah. All right, guys. With that being said, thank you guys so much for watching, and I will see you guys on the next.
We'll do it live.
Okay.
No. We'll do it live. F it. Do it live. I'll write it and we'll do it live. F***ing thing sucks.
Yeah.